This visualization shows a high-momentum market suddenly grinding to a halt. 1 minute, price action is whipping back and forth with wild volatility, and the next, it flatlines into a tight sideways crawl. For most traders, this sideways crawl is a frustrating dead zone. They try to chase every minor twitch in the price, getting chewed up in erratic chop, and slowly bleeding capital in a market that refuses to pick a clear direction. This consolidation phase is a Forex squeeze. It functions like a massive digital spring, building up kinetic energy as it is compressed toward its absolute limit. Volatility has completely dried up, creating a temporary state of equilibrium. Buyers and sellers are locked in a stalemate, with neither side deploying enough capital to take control of the asset's price. That tension can't hold forever. If you learn to map these periods of deep indecision, that frustrating quiet phase becomes the staging ground for a massive, explosive price breakout. To trade that eventual explosion, you first have to draw the physical boundaries of the market's indecision on your chart. This chart illustrates a classic triangle pattern. As the price forms lower highs and higher lows, you can see the white boundary lines converging, visually mapping the market pressure building as the trading range gets tighter and tighter. Other times, the market boxes itself in. Here, the structure shifts into a rectangle or a parallel channel. The price is bouncing, trapped between rigid horizontal levels, and a breakout over either line signals a clear winner in the battle for control. These geometric shapes don't predict which way the price will eventually go. What they do is define the exact containment area where the next major move is currently incubating. Drawing lines on a chart is somewhat subjective. To truly measure the pressure, traders rely on objective mathematical indicators to prove the market is abnormally quiet. Look at this diagram of Bollinger Bands. These two outer bands track standard deviations away from the average price. When volatility drops and the price action flattens out, the bands physically contract. When these bands pinch down to their narrowest width in recent history, it creates a Bollinger Squeeze. It serves as a strict mathematical alarm that the quiet period is ending, and an expansion phase is right around the corner. To filter out false alarms, advanced traders add a second layer of confirmation, Keltner channels. These channels measure the average true range, the asset's raw daily price movement. The highest probability setup occurs when these indicators overlap. When the highly sensitive Bollinger Bands compress entirely inside the Keltner channels, it flags a maximum pressure state. This rare indicator alignment provides evidence that volatility has reached a historical low and identifies a unique state where the market is primed for a sharp, high-velocity expansion of price action. This is what that release looks like in real time. The built-up kinetic energy snaps, and the price violently shatters the established geometric boundaries. When that barrier breaks, you have two tactical options. An aggressive entry means buying the exact moment a strong candle closes outside the boundary. It gets you in at the earliest price, though it carries a higher risk of price reversing back into a trap. As shown in this diagram, the alternative is the conservative entry. You let the initial breakout happen, wait for the price to pull back, and test that old broken resistance as new support, and only then execute your trade. Regardless of your entry style, you have to build a safety net. Place your stop-loss order just outside the pattern's opposite edge. To cash out, we use the measured move. Copy the squeeze's widest vertical height and project it upward from your breakout point to set a logical take-profit target. Implementing strict rules for where you enter and using objective mathematical targets for where you exit transforms a chaotic price spike into a controlled professional trade. Even with perfect execution, your biggest threat during a squeeze is the false breakout, when the price spikes out of the pattern just long enough to trigger your entry before abruptly reversing and hitting your stop loss. You can see here how to defend against those traps using multi-timeframe analysis. Notice how this tight upward squeeze pattern on a 15-minute chart perfectly aligns with the sweeping dominant uptrend of the daily chart in the background. Trying to trade a 5-minute bullish breakout directly against the heavy current of a massive weekly downtrend is a fatal error. Trading the squeeze allows you to find opportunity within the market's deepest indecision. By pairing structural patterns with objective volatility tools, you can align your entries with the exact moment that compressed energy is released. Stop bleeding capital in the dead zone. Practice identifying these volatile compression cycles and layering Bollinger and Keltner indicators on a 0-pip spread FXNX demo account today.